I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome back to the show, Tim.
Jim, as always, thanks for having me.
Tim, in the past, we've talked about market manipulation by all the central banks, quantitative easing, and so on. In the long run, does manipulation matter?
In the long run, Jim, I don't think it does. And an example of that is, if you look back at 2000, the extension of the four-year cycle in 2007 and how it ended. There's no example in history where manipulation has ever been long-lasting. So in the long run, no. I mean, there's not a single occurrence of manipulation over the long haul that's stuck. And in fact, it only makes matters worse. Now, in the short intermediate term, you darn right it matters. And they can create bubbles, and we've talked about this many times, but that's what has happened, and that's where we are. I mean, we're dealing with, I know it sounds like a broken record, but the most extended four-year cycle advance in stock market history. I think it's also one of the biggest bubbles, I think, in history. So yes, it matters in that respect. Long term, there's no way, there's no historical precedence. It will not hold, and it only makes matters worse in the end.
And yet we see wave after wave of quantitative easing or asset buying across the planet. Whenever Europe runs into trouble, they do it again. China does it. Japan does it. Why do they keep doing it and not let the natural cycle run out?
I don't know. I guess it's just human nature to try to fix things. I don't know. I don't know that answer. That's the only answer. I mean, it's one of two things. I mean, either A, that it's going to make matters worse and you do it deliberately. I wouldn't think that's the case. Or two, you think you can fix things and you try to do it to provide a Band-Aid until the economy picks up and things get going again. And so but that doesn't work. You need the natural ebb and flow of the cycle. You have to have the business cycle. It has to happen. It's just nature. It's like day without night and vice versa. It has to happen.
Of course, in science fiction, the Earth stood still just to show that we can't run everything. But with all this manipulation going on, does it all balance out?
How do you mean?
Well, if it's constant, does it now become just part of the background noise for the markets?
No, I mean, not from a technical perspective. From a technical perspective, Jim, it doesn't matter what's driving price. I mean, at the end of the day, it literally at the end of the day, it is a price bar with an open, a high, a low, and a close. And at the end of the week, it's literally a weekly price bar, and at the end of the month, it's literally a monthly price bar. So the technical analysis does not change. I mean, we're still seeing the short-term cycles. We're still seeing the intermediate term cycles ebbing and flowing. We're still seeing right and left translated cycles. I mean, the cycles are still very much alive. It's the longer term four-year cycle, the longer term picture that is being blown up and blown out of proportion. So I don't know if that answers the question or not, but I mean, it doesn't matter what's driving price from a technical perspective because it's still just price. It's all still just discounted into the price of the bar.
How much money have governments lost trying to prop up the markets? How much money has governments lost trying to prop up the market?
Oh, God, I don't know. I don't keep up with the fundamental stuff. I have no idea. I just know that we would be far better off if they had let things as painful as it would have been, let it go, and let the market, the natural forces of the market, wash things out. Following the 2009 decline, of course, they did their thing then to stem that as much as they could, and I think there was, probably some effect to what they did. But if they'd have just let this wash out, we would be done. We'd be over with, and we would be on solid ground. You have to have that washout. I'll give you a couple of examples. Going back in history, looking at all of the secular bull and bear market periods, on average, the secular bear market has been about a third the duration of the preceding secular bull market. So if they would have just let things go following the 2000 top, instead of blowing that 4-year cycle up into 2007, we would be long. Let me back up again. The secular period ran from 74 to 2000. So if they would have just let that go, we'd be years down the road in recovery. The natural bottom of the market would have been around 2010. And yet they're still fighting the deflationary forces that are trying to take hold. And make no mistake, that is what they're fighting. To reinflate and to put money in the system, you are fighting deflation. And so they're still fighting those forces. And like I said, if they just let nature run its course, we'd be done.
Why are central bankers so set on not allowing deflation, letting prices come down and make things more affordable?
I don't know. I guess the loss that maybe they face, and I guess maybe the other aspect of it is trying to bridge the gap on the downturn of the cycles, and it just it just doesn't work in the end. It's kind of like another kind of a crude example, but I remember one time I had a bad upset stomach, and like a stomach bug, and I stopped in the little local pharmacy one time and I asked the pharmacist, I'm like, man, and he said, yeah, there's something going around. Let me give you something. And I don't know what it was he gave me, but he said, yeah, it kind of turns your, and pardon the frankness here, the crudeness here, but he says, yeah, it turns your puker off. Well, I thought, okay, that sounds good to me. And I took this stuff, but I was just sick. I couldn't throw up. Once I finally did, I was fine. It's the same thing. You have to have that purging with the market. They've turned the puker off. They need to let it purge. And then we would have been on solid ground.
Of course, politically, it's very hard to be in charge when things go downhill.
True. I don't know what someone else is thinking, and I'm not saying they're sinister in intent. I don't know. And I'm not saying that they're ignorant by no means, because that's obviously not the case either. They wouldn't be in the position they're in. It's just I don't know. I don't have those answers. All I know is history tells us that it doesn't work. It makes matters worse. And as far as manipulation in the market, there's always been manipulation in the market. And like I said before, this is nothing new. Yes, this is probably the most manipulated period ever. But I think the most extended bubble ever. But still, it's all the same.
We'll have more with Tim Cyclesman Wood right after the break.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, taking a look at the cycles that should be happening, where is crude oil right now and what can we expect?
Crude oil and really gold as well. Well, no, there's a little bit. The cyclical differences are, there are differences, so let me take them one at a time. Crude oil, I think we've discussed that the intermediate term top, the seasonal top, if you will, happened back in June, and then in early August we had an advance, and we said that it should be a counter trend rally and that crude oil should go lower, and that's still on track. There's been no changes whatsoever. I think that crude oil and commodities in general are going to try to continue lower into probably the end of the year. If we see some structural changes between now and then that tell us something otherwise, then so be it. But as of right now, the structure, which is what cycles are, by the way. Let me digress just a minute. When you talk about cycles, that's all you're talking about is just the structure of the market, with right, left translations of varying degrees. And as long as that structure is positively, has a positive right translated structure, then the market's going up. And when it rolls, it turns to be a left translated structure, and then the trend is down until the structure changes. And so the structure with crude oil, it's down at this point.
Now, of course, there's talk. It seems to me once a week, somebody in some major oil producing country says, well, we're looking at capping production. It doesn't happen, but it boosts the price temporarily. Do they feel that's good enough? Just talk about it. You don't actually have to turn a tap down.
I think that's a form of manipulation to try to, jawbone it. Absolutely. And sometimes it works and sometimes it doesn't. If it sounds crazy, but, if the higher degree cycles have turned down, doesn't matter what they say. It's going down. And, when the higher degree cycles bottom, then yes, that works. So it's really about the structure, again, of the market.
The gold cycle, where are we right now?
Kind of the same thing. Gold, we said that the advance out of the December low last year was a counter trend advance, and it was a good one, no doubt, but that there should be one more push down into the higher degree 9-year cycle low, and that we saw the high back in July, August, and of this counter trend bounce, that is. And I think so far that's on track. Now, it hasn't given up much ground, which I think is a positive thing, given that we've seen that intermediate degree cycle. But I still think at this point the risk is to the downside in a retest of that December low. And again, until that structure changes, that expectation, stands.
Should people then wait if they're going to buy gold, or is it always a good idea to just buy a little bit now and then anyway?
My thinking is I would want to buy at that 9-year cycle low. I mean, if you could buy something, here's the risk. It's all about the quantitative aspect of the risk. And if you see something that's happened 90% of the time, 80% of the time, then you would tend to expect the outcome to be, 70-80% chance that the next time you see it, it's going to happen that way, right? I mean, that's reasonable, correct?
Yes.
And with gold, nobody wants to hear this, but they're in the 9-year cycle. I call it a 9-year cycle because it has 9 of these little. They're a little less than a year in duration, not quite a year, but that's the label I put on it. But there's this 9 of these little annual cycles within the 9-year cycle. Well, since gold's been freely traded, not 80% of the time, not 90% of the time, but 100% of the time, we've had 9 of those cycles. Well, and within that 9-year cycle, thus the name 9-year cycle. Well, so far we've only seen 8. So, based on that statistic, you would logically think that there's going to be one more before we get to the bottom. And so that's why I'm saying the low in December was cycle number 8, not 9. And so if someone wants to gamble on that, hey, that's fine. The odds are 100% against it. Maybe this time's different, but now you're betting on an outlier. And so for that reason, until the market can prove to me that this time is different with the decline and I can identify that annual cycle low has occurred at a higher level than the December low, then the risk is, at minimum, the risk is that 100% statistic is fulfilled and the gold goes below 1,050. And that's news that no one wants to hear. That's fine. That's what the statistic says. So I want to wait to be a buyer until A, we see the statistic fulfilled and you can buy gold $300 less. Hey, what a bargain. Or we see that this time is different and structure proves that this time is different, and maybe you can still buy it at $1,250 or $1,200 when that cycle bottoms, if this time does in fact prove different, which either way is a win-win. But right now, knowing that statistic and knowing that we have the structure that the intermediate and that intermediate and annual cycle has, by all appearances, peaked, the risk is not of losing out on the upside. The risk is of buying now when you could buy it at a lower price, in a few months. So that's where we stand with gold. I hope that makes sense.
Right. Now, I know gold miners have really had an upshot this year. Would you still hold on to them or maybe sell it now and then wait for them to go lower?
Well, actually, we had sell signals on the gold miners. I don't remember now. It's been so long ago that I don't remember. But I want to say a month, 6 weeks ago or longer. And so, yeah, it was back in early August. I think they're going to be under pressure with gold. And with equities trying to crack, I think that the risk to them is that, is of the downside here. Now, what I would expect while I'm looking for gold to, I know it sounds crazy, nobody wants to hear it, and unless this time's proven different, so let me preface it again, the expectation is for the December low to be violated in gold. I do not expect that with miners, because what you often see at the 9-year cycle lows is that the miners will bottom ahead of them, and you'll have a divergence, if you will, a positive confirmation where the miners, they'll go down and retest that low. They'll make a higher low. And that would be another clue once we get into this next annual cycle low, if we should see that we have indeed seen the 9-year cycle low.
Tim, is there anything else we should be keeping an eye on right now?
No, that's it. I know people think it's, at this point, it goes in one ear and out the other about equities, and I get that too, but, it's the biggest powder keg ever. I don't know what's going to prick the bubble, but, you go through, we talked about this before, but you go through these intersections of opportunity from a technical perspective. And every time you go through them, it's like walking through a minefield. Doesn't mean you're going to step on a mine, but it means you could because you're in the field. And when we go through these technical junctures like that, it creates the opportunity. And when it happens, it's going to happen. It's going to go kaboom. But, so far, you'll get a setup and it just kind of doesn't quite materialize all the way, or it morphs and it turns into, an even bigger topping process. And, for example, June 2015, the Dow theory primary bearish trend change fell into place. Well, it's still there. In spite of all of the advances, in spite of we've had 3 intermediate term advances, it's still there. So on the one hand, you look at it and you say, well, the market hadn't cracked. Yeah, that's true. So that's a check on the positive side of things. But the fact that the market hadn't been able to blow that out and it is still there, that's 2 checks on the negative side of things. A, it's still there, and it's not so strong. I mean, it's not strong enough to have blown it out. So it's a huge topping process. And who knows how long this is going to take. One of these setups and it's going to go kaboom.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. Our Twitter handle is @TalkDigitalNet. Check out our YouTube channel, Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.